Good morning, good evening, good afternoon, wherever you're listening to us from in the world. This is Jake Claver with Beyond Broke on the Future of Fortune podcast, joined by, as always, by my partner, Byron Wolf. How are you, Byron?
I'm good, brother. I'm good, man. Love to be on this one. It's gonna be a good day. We're talking about staking and crypto lending in the wake of the Kraken settlement. Multiple settlements hopefully happening here in the near future. Definitely changing the way that crypto functions, the way that people make money on crypto. Although it didn't really break the internet the way that I expected it to, it's definitely big news in the crypto space. So excited to get into this one.
Yeah, 100%. You'd have thought that more people would have been upset or been talking about this, but what did the settlement end up being? It was $30 million is what Kraken settled with the SEC over their staking protocol.
Yeah, $30 million, which, I mean, it's a ton of money. Like, I'm not trying to downplay that, but the big piece of it, to me, the more important piece was that Kraken had to shut down their staking protocol.
Right.
So to me, that was probably more important than the 30 mil is the fact that they are no longer going to be staking. They've shut that process down. Are they going to be picking up crypto lending? I don't know. I'm not, sitting in their boardroom listening to what's going on. Totally their fault that they don't invite me to these things, but it is what it is, right?
They definitely should be.
They should be. Yeah,
so
I should be there, fly on the wall.
They were the first crypto exchange that ended up getting a banking license, and they are in Wyoming. So all my crypto LLCs in Wyoming, and I'm sure that's where you encourage people to file as well.
Yes.
But yeah, with that happening for them, I was just telling Byron that I was listening to Link2's webinar that they had with Jack McDonald, who's the CEO of PolySign.
Yep.
And he was really excited about this news because it basically gave them the stamp of approval from the SEC for the way that they're going to integrate with the banks and allow for crypto lending instead of the staking protocols, right? So
yeah. So big question. I know our listeners are, there's probably tons of them that know exactly the difference between staking and lending, crypto lending specifically. But for those who don't, let's get into that real quick and explain the differences, Jake. So crypto staking, what is it? What does it do? How does it work?
Okay, so if you're staking, you're going to be partnering with a liquidity provider or somebody that's running a node on the network, and you would be delegating or giving them your crypto. So they get control of it, and then they have it in their protocol. And if it's locked up, then that's great. But sometimes it's not locked up and they do some shady things with it, and they're not a good custodian and they're not approved, right? So that's where the risk comes in on this deal. As far as lending goes, you would be lending it to an institution. And the way that the Jack had it set up, they basically escrow the asset and they remain in possession or have ownership of the asset, but the other party has control of it. So they can use it in their liquidity pool or their staking node to earn the interest on it, but they don't actually have possession of the asset, and there's no liability or way for them to do questionable things with the asset. So much safer, much more like a bearer asset inside the traditional financial system. And I think that they do things on purpose and move in certain ways, and I think they're ready to start implementing this with banks, and they allowed the staking to go on and the crazy yields to go on so that they could step in and kind of regulate the space and then bring in the suits, as I call them, to really, bring maturity to the space. So we'll see what happens over the next few months here, but I have a feeling that PolySign was very secretive for a long time, and now that they're moving out into the public eye, Link2 is offering their private equity on their platform, and they're having these conferences and basically discussing what they're doing instead of just hiding in the background. I have a feeling that that's going to be brought to the forefront before too long.
Yeah, I agree. And I think lending will get, much more popular now that staking's out. So just to kind of rewind a little bit, with staking, you're going to earn rewards. So that's kind of how you get paid for your staking. They take your crypto, they use that to validate transactions, a couple other things in there, and then you get rewards for staking that stuff. With crypto lending, you're essentially getting the interest on it. So same as like putting up almost any other collateral. It just happens to be crypto in this. The one thing I do want to point out on that is it has not become mainline yet. So the crypto lending, generally they want a higher margin of error, so to speak, because they know that crypto moves more swiftly than other assets. You give them gold, silver, your house, whatever, they know that like that asset probably is going to stay, it's going to follow a very specific outline of ebb and flow. Whereas with crypto, not as concrete, even Bitcoin, number one coin, we've seen huge ups, huge downs, right? So, if you say, well, hey, I'm going to go take this, this Bitcoin that's, worth $35,000 and I'm going to get a $30,000 loan against it. Probably not going to happen, because they're not sure that it is. And realistically, anybody that's going to give you 30 on a 35K Bitcoin, that's a little risky. So I would watch your paperwork. Yeah, they're going to take it from you. Yeah, because as soon as it drops below, like, hey, now it's theirs, and you still have a debt, right? And so that would be where I would say, hey, be a little careful. So although there's risks on both sides, like Jake said, staking, your stuff could just magically disappear. With crypto lending, if the bottom drops out of it, they call it due. You could lose out on it there as well. But I agree with Jake, 1,000%. The crypto lending is a little bit safer for the majority of crypto investors or just generally everybody, right? Although staking has become very common, the thing that concerns me about the staking is because it was so widely available, I think there's like an assumption that like, oh, hey, if Coinbase or whoever has it, it must be safe. It must be clean, whatever. And that's just not true. Not true. So
put yourself in the sling. Yeah, and the other piece of the lending, right? So the collateralized loans, which is my favorite option because there's a loan, there's no tax ramifications. If you do use a volatile asset like Bitcoin, Circle even offers this. So they have USDC, and they'll allow you to take loans in USDC against your Bitcoin. And I think they'll do. I think it's over 75% on collateralized loan for your Bitcoin. So if the value of your Bitcoin, let's say, you did that at 50,000 and then it dropped all the way down to 17 or 20, whatever it ended up bottoming at, like they took possession of it during that period. You owed them that amount of money, and the liquidity and the collateral that you put up dropped below that value, and they took it from you to cover their exposure. So that's the risk that you run on those types of deals as the market becomes, widely adopted and there's more money that moves into the space and it becomes mature. I think those volatile swings will be far less, but everybody likes the volatile swings because that's where the money's made. Just depends.
Yeah, depending on where you're at in the play. But
100%. So we'll see how it ends up shaking out. But I'm glad that they're finally kind of moving in some regulation around these markets and picking out the different details that exist, so that the retail investor again is lost. Well, with FTX and everything that went on there, Luna, everything, Voyager, Celsius, there's been a lot of problems over the last 18 months with crypto. I guess it's been about a year because Luna happened April of last year and we're in February of 2023. So last 12 months is when we've really seen the collapse of what was exchanges and the staking and all the craziness that was going on. And that's what's allowed them to bring in this regulation. So what type of rates do you think we'll end up seeing, or what amount do you think is fair, and where would you be cautious?
So to me, it's gonna depend heavily on the crypto asset, So like we said, even Bitcoin had wild swings, right? And so I think like the people that are in, say top 10 are going to get a much better rate, obviously, than those that are in, everything below the top 10. And really just, that top 100 cryptos are probably going to be the only ones that are even going to remotely qualify for any kind of lending whatsoever, unless it's a very specific need. Again, this is not financial advice whatsoever. Anything you hear on here, make sure you check with your CPA or your legal team, your financial advisor, whatever. We're not trying to tell you what to do. But I do think that if it has good utility, I think you're going to get a better rate. Like Jake and I are both heavy holders in XRP because we believe in the utility of what XRP is going to be doing. So to me, if XRP does exactly what we believe that it's going to do, and it gets approved and they get through their lawsuit, and there's a lot of things that need to happen for this to happen, but that utility is going to be very, very useful. So two things I believe will happen. I think it will stabilize somewhat the price point. I think it will continue to go up because of that utility, but I think it will stabilize. Two, because it has that utility aspect to it, I believe it's going to get a better rate. And you're probably going to be able to lend more against it because it won't have as many of the highs and low ebbs that a lot of the other ones have. Bitcoin specifically, big holder of wealth. I think a lot of people believe in Bitcoin regardless of its utility. A lot of people probably don't even know what the utility is. They just heard it so many times. First to market. Yeah. Bitcoin, it's got to be great. It's amazing. It like makes ice cream or something. Who knows? But it's stable and people, relatively stable. And people believe in it. And I think that's a great thing, right? And if the utility can really flesh out, I think, it could follow the same format. Now, if you have some one of the other ones, like I think Polkadot, I think is the most widely held staked crypto currently, and don't fact check me, but I believe I've read that.
I think you're right on that, actually. Yeah.
So, Polkadot, it's going to, because of the heavy staking, if everybody has to remove staking and it goes back to what it is, because it was such a heavily staked asset, I believe it will possibly be a good lending platform, because I do think there's some interchange between those, between staking and lending. Again, big reason why we're having this conversation is a lot of people don't know the difference between crypto staking and crypto lending. So based off of that, I think that it may be another one that people will go to do the crypto lending. Like, I'm going to put my money in this. I believe in crypto, but I want to get that loan back out. I want to have those funds that exist while also having some appreciation. So I think that the basis will still be low. I don't anticipate anytime soon having the 70, 80, 90% loan to value. I just don't see that as a reality. Too much volatility. But I think that the rate will be pretty comparable to other assets. It's just the loan to value is where I see the big, the big lack.
Yeah. So what's a HELOC? When you go to take that equity out of your home, what type of rates are you seeing there, and how much will they loan against the equity in your house?
Yeah, so with a HELOC, they'll go pretty high. I've seen those as high as like a 95 percent loan to value. Now, granted, whatever mortgage you have is going to come out of that. So if you've got 20% equity, then you're really only getting that 15% that still exists. Most of those are going to be at a 90% loan to value, so you're going to get that 10%, and it's going to be a little bit higher rate that you're paying than what it would be with like a main mortgage, because it is a secondary position for the most part. So you may be able to get 2 or 3 points above prime. On that primary, you're probably going to be looking at 5 or 6. So what I've seen in the market is 2 to 3 extra points. Again, credit score goes into this and creates that. So I'm just assuming
there's a lot of different factors that could play in. I just, as an example or something tangible for people to look at in the real world versus crypto, because again, this is so new. I just wanted to give them something that would be similar, right?
Yeah, we talked about XTC, and you mentioned that, we're looking at about a, 10% on that. And I think that's going to be great, because I think realistically, you're probably going to be maybe 7 or 8, so at 10%, that's solid. Like the US stock exchange has historically returned, about 10%. Which is great, guys. And I think there's so many people that get into crypto and they're like, I'm going to 5 million X my investment. I'm going to invest $3. I'm going to be a billionaire. That doesn't happen. And there are a few people that invested a few thousand and now they're millionaires, but Man, I mean, you talk about a lottery winning like that. That's what it is. So 10%, super, super solid return for a consistency and a very high likelihood of that 10% occurring. Nothing's perfect, nothing's guaranteed.
Well, so that's the other deal with this protocol is, so we're launching a master node on the XDC network, and there is no staking that's currently available for this. So you have to operate or be part of a master node in order to get that yield on the asset. And it validates transactions, and there's rewards that are paid out to the validators that are then, taken by them if they have the master node, or dispersed amongst the investors. And so we're going to do the first SPV raise in crypto for a master node project. I got partnered with Syndicate to do that. So we'll see what the logistics looks like. But this is a real world application for this, and it's not ever been done before. So we're kind of pioneers in that area, which is cool.
Yeah. Yeah, no, I love it. I love it. And, and there's new stuff that's happening all the time in crypto, which is, another huge reason that I love it. I know it's a reason you love it. We're setting new parameters. We're doing new things. They make sense. We're changing the format upon which people make money, right? Future of fortunes, in the name. So, I do think that these things are going to become more and more prevalent. They're going to be more and more not necessarily the norm, but they'll become normalized. And that to me is really cool. I love the idea of these. I love being able to get a good return on your money while also being kind of on the cutting edge of where the crypto is going. So you talked about a master node. I know there's a lot of our listeners that probably do know what that is. A lot of them that don't. Can you explain that one real fast?
Yeah, for sure. So all these networks, they have different forms of consensus. And what consensus is they validate a transaction happened in a certain order. It's basically just like a giant ledger, right? That's what blockchain is. And there's a whole bunch of different computers that all validate the same transactions. And each one of those computers would be a node or a validator on the network. And for this particular network, they don't allow just anybody to run a node, and what they have are called master nodes that have been approved by the foundation. So that's what a master node is. It's just one of the validators that processes the transactions on the network and then correlates with the other people that are processing transactions to verify that something happened in a specific order.
Yeah. So like in my space, there's different people that can do different levels of financial stuff. And so there's bookkeepers, there's accountants, then there's CPAs, right? And so CPA is a designation. You have to go through a lot of schooling. You have to be insanely smart. I only say that because I am also a CPA and I'm very humble. But there's a licensure process, right? So what a bookkeeper can do, not necessarily like a CPA can do that, but a bookkeeper necessarily can't do what a CPA does. So with the master nodes, there's the nodes, and then there's this like higher level master node. So like, is that a good comparison, based off?
Yeah, I would say that, well, there are, for this network, there aren't any other nodes, and they only allow a certain amount, right? So people can get into the idea of a decentralized network or a centralized network. If you're having to approve the people to be on the network, it's probably a bit more centralized, right? Because not just anybody can hop on there and run a node, but you also run into people that are malicious or might do things that would be bad for the network. And so I'm glad that there is an approval process. But yes, that's just the designation for a node on that network. It's not like there's tiers, even though it kind of insinuates that with the name.
Yeah. And our listeners know this. Jake and I are both very big on realistic regulation. Like we do believe that there needs to be regulation in the market. I don't like regulation for just political reasons to get you elected or, to stand out to your buddies, in DC. But I do believe in like realistic regulation, like, protecting the people that don't necessarily know exactly what the process is. And this is kind of that, right? Like you talk about the difference between decentralized, centralized, like having some kind of vetting process. Huge fan of that. I think a lot of people will get into these spaces because they want to be that guy that puts, $1,000 in and becomes a millionaire. And it's so extremely rare. Probably, you hear those stories, one, they're probably not true, or two, there's something different that happened in that,
Well,
maybe they created a rug pull or something.
there's a time frame that's realistic with that also that I think people don't really understand. So everybody's hopeful that they buy the bottom and sell the top, which normally doesn't happen. And even if you did, it's only a little over 2 years between those intervals. And so there have been instances, again, like to what you just pointed out, where there's a rug pull and people get in because their buddy tells them before anybody else does. They run the coin up and then they dump on everybody else. They sell their share and it plummets the price of the token.
Yes.
I don't want to participate in any of that, right? It's unethical. You're taking other people's money. So I'm excited for regulation to come into the space, but again, there's that cost to benefit, right? If you're in late after things are established, there's normally not as much money to be made on things, but it's safer. It's less risky. So been having a lot of conversations around risk profile and age and those things here lately. Just discussions with individuals I've been having. And if you're, closer to retirement, maybe crypto is not the best spot for you. Or if you do, if you are closer to retirement, maybe it's a small allocation that you have there. Like you had pointed out, investment advisors were up to, somewhere around 5% is their allocation for crypto. And now they're back to 1%. Whereas I would have gone the other direction. I probably would have been 1 when things were going really well. And now I would look at like 5% while the market's down, because that's when the opportunities come in, the asymmetric bets exist. But yeah, we'll see how this is implemented with traditional financial brokers and how they're incentivized, because that'll play a big role in the allocation that they want to put toward these things. And the regulation will help with that as well, right? If there's institutional custodians that are responsible with these assets and they're compliant with FINRA and the SEC and these other regulatory bodies, then that makes it much easier for financial advisors, wealth managers to offer these types of products to their clients, because they make a little bit of money on there, and the markets will be safer. So
yeah, I agree, and that's what we want. We want a safer market. We want a less volatile market. We want, I'm not saying like it has to be, everybody needs to be on the same level. Like obviously, if you do your research, then and you're more informed, you should have a better chance of success, right? Like I'm not trying to keep people down. I just want to eliminate, the phone calls where like your IRS debt comes due and, the only way to pay it is with a Walmart gift card, like that. We're trying to avoid those scams that, you see out there and get away from the rug pulls. If you don't know what a rug pull is, Jake explained it pretty well. Essentially, they create a coin, it goes up, everybody pulls their money out. The people that thought they were getting appreciation, they get stuck holding the bag, right? And that should be illegal. Like realistically, there, but again, look for utility, like we talked about with the lending thing, the coins that have utility, that have a purpose, when I say utility, I mean an actual purpose, like a usefulness, look for those, because if the crypto doesn't have any usefulness, doesn't have like a legit purpose, then it's not a good one to get invested in, and that can be personal. Like maybe, if you're a music producer and there's a coin that has some functionality or some utility for that, like you're going to probably know a lot about that, get into that. Right. But if you don't know anything about it, then, don't get into stuff that you don't understand. Like just because your uncle's neighbor says, hey, this is a good play, like doesn't mean that it is, like do your research.
I'll give you a specific one, right? So Cardano. I think they have fantastic technology. I love the founder, Charles Hoskinson. I think they have a great team and a great board. But everybody I've asked about Cardano, what it's going to do, how it's going to be used in the real world, they can't tell me.
Yeah.
They have no idea, because it doesn't have a specific use case, right?
Yeah.
And so you can own it because you believed in the technology and what it's capable of, but at the same time, I don't own any because I don't know what it's going to do, right?
Yeah.
Like if they could give me a tangible use case and say, hey, here's their partners, these are the people that are already doing it with this, and this is how it's going to happen in the future, I can get behind that. That would be great. Read the white paper. It's very technical, makes a lot of sense. Like I said, smart contract features on that network are fantastic. But again, until there's a real world use case and application for it, I have a hard time putting my money there. And that's just, again, none of this is financial advice. Always consult with your financial advisor before making any investment decisions, but that's just my 2 cents.
Yeah, I mean, you're better off to go to Vegas and just throw your money on a random table and say, yeah, I'd like to make a bet, like without knowing what the game is, what the rules are, or anything else. Like, I mean, I know if I go to a roulette table, and it's black or red, I have roughly a 49% chance of hitting on whichever one that I pick, right? And so to me, I know the risks, and I also know the rewards. I know what the payout is. But like, you wouldn't walk up to a roulette table that you don't know anything about and blindly put all of your chips somewhere on the table. Like, it doesn't make any sense. Like, know what you're doing, know what you're gambling, know what you're betting, know what the potential rewards are, because you're right. Like, in Cardano is one of those. I would say it's still probably in the top 20, right?
Yeah.
Realistically.
Great project. A lot of people believe in it, but
yeah. Who knows what it's going to do?
Yeah, I have no idea. And they'll tell me, there's all these things being built on the network. There's these dApps, there's this and that. And I'm like, okay, so what does it do? Well, we have NFTs. Oh, okay. Well, is it tangible artwork? The vehicle titles, like we even looked at that network and putting that on there. There's just a lot of different things that it could be used for, but nobody's actually nailed down something that it's going to be used for. So
yes. Yeah.
We'll see what ends up shaking out with it. I wish them all the best. Again, I believe in the technology and what they built. I just have a hard time putting my money there without having a nailed down use case with it.
Yeah, no, I agree with that, 100%. And they've done a great job building it up to what it is. And there is a lot of great information with the backing. And I think that they'll figure it out. And I think that it will be one of those. It's just, when is that going to happen? What is it going to be? It's a risk that I'm just not ready to jump into quite yet. Now, if they figure out something, and there's a good backing, I'm all for it. If Elon Musk said, I've got a great idea, I would probably wait and to find out what the idea was before I threw money at it. Some people would say, oh, well, it's Elon, I'm going to throw money at this idea. Well, maybe it's an elevator to the moon. And like, as cool as that sounds, I don't think it's realistic, probably not going to put my money on that. But, he's a smart guy, brilliant guy. There's a lot of good backing for like his ideas. He's done well with a number of things. And so there are people that would say, yeah, I don't care what it is. I'm just putting my money behind that, which to me, that's kind of what investing in Cardano is like right now. But if he came out and he said, hey, this is the idea, this is what I'm going to use the money for, and it made sense and it seemed like a good investment, I'd be all for it, because I know that he's a smart guy and he probably has a intelligent build up to that point. He has a framework in mind and he's probably going to find success. I would be interested in that. Again, probably not the elevator to the moon, but if it's another, Tesla type vehicle, hell man, I'm all for it. Probably going to be a good thing.
Company or one of the other ones. And you can stake Cardano also. So that's another piece of that network. What does it do going forward now that they don't allow staking? I think they do need to get, very particular about in what case they would allow staking. Does it have to be through a traditional investment vehicle like an SPV? If you're going to raise and then, pay out to your people, who's going to custody the asset? Is it going to be PolySign, Standard Custody, one of their companies? Will BNY Mellon get into that? I know Jack McDonald worked at BNY Mellon for 30 years before he came over to PolySign, so I'd suspect that they will be utilizing their technology. I mean, they're the world's largest custodian at this point. So I think banks will partner with them, use their technology, and allow the crypto lending. And for you to stake with something, I think it'll probably end up being pushed to, that type of deal where you've got to raise through a certain vehicle and then be able to delegate and pay out rewards through the legal and financial way that currently exists.
Yeah. And, and rewards are great. I love getting rewards for things that I do, as a child, like that's the best way to teach your kid to do this or to do that. So we're not, we're not saying that rewards don't work and like that they're a bad thing. But SEC has said no more staking really, with this. So we'll see what happens.
With this masternode, I'll give you another deal. Traditionally, if you were to raise capital for it, you would offer the investors, so you're going to get a 10% yield and you get a management fee and all that stuff in there, you pay out like 6 or 7%, right? So it becomes cutthroat for people that are doing this also, because if you wanted more liquidity and you wanted more people to come stake with your node, maybe you give them a higher payout than your competitors. And then it's a race to the bottom because you have to have so much of that to operate, right? And if you're in a bear market and the token goes down, like you've seen all these Bitcoin mining rigs shut down, and the network becomes more centralized because there's not as much money to be made. So it's kind of the antithesis of what the whole point of the network was, for decentralized. So I don't think they've figured out the best incentives for this or the way to structure it yet, but I do think it's coming. And with regulation, I'm hopeful that they'll kind of strike a balance of what's fair to investors and then also a viable business model.
Yeah, I agree. 100%. Oh, man, that was good. That was good stuff. I like the topic. I think that helps a lot of people to understand the difference between the two. I'm sure there are people out there that didn't even know that there was two sides to that, staking versus lending. So hopefully that explained it. For those who knew that stuff already, hopefully we gave you some knowledge to help you further your understanding of staking versus lending. For those who had no clue what either one of those are, the good news is I think staking is on its way out. So you didn't lose anything. You know, it's you didn't need to understand it because it's probably going to go away. So
100%. Well, appreciate you as always, Byron. I hope everybody learned something here today, and looking forward to seeing you on the next one.
Yes, sir. Great day, man.
We'll see you.
See you guys.